I've spent years studying the stories of markets, the rise and fall of fortunes, and the timeless lessons left behind by those who truly understood investing. And among them, one figure stands above all: Benjamin Graham. You may know him as the father of value investing, the man who taught Warren Buffett to think, the author of The Intelligent Investor. But more than a teacher, Graham was a philosopher of patience, reason, and human behavior. He didn't just study markets, he studied people. And through that lens, he uncovered truths that remain as relevant today as they were in the chaotic streets of Wall Street nearly a century ago. Today, I want to share one of Graham's most profound insights. Not every investor is the same. In fact, Graham identified three distinct types of investors, each with their own temperament, goals, and approach to risk. Understanding which type you are and acting accordingly can mean the difference between steady growth and needless loss. We'll explore the defensive investor, the enterprising investor, and the speculator. We'll see how Graham observed their strengths, their pitfalls, and the behaviors that determine their success or failure. Along the way, I'll share stories from his own era, the roaring 1920s, the collapse of 1929, and the Great Depression. And we'll connect them to today's markets, where emotions, hype, and speculation still reign supreme. By the end of this journey, you won't just know the types of investors Graham described, you'll understand yourself better. You'll see where patience and discipline fit into your approach, how to avoid the traps of impulsive action, and why the calm investor almost always outlasts the restless one. And so, let us begin with the dilemma that has faced every investor since the dawn of markets: how to survive and thrive in a world ruled by emotion, uncertainty, and opportunity. Because in understanding the types of investors, we begin to understand not just the market, but the human mind itself. But before we classify these investors, we need to confront a question Graham always asked: why do most people fail at investing even when the rules are simple? That question leads us to the dilemma every investor must face. Benjamin Graham observed a harsh truth. Most investors don't fail because the market is cruel, but because they fail themselves. The greatest obstacle to long-term success is not a crash, a bubble, or a market correction. It is our own behavior. During the 1920s, the stock market seemed unstoppable. Prices soared, fortunes were made overnight, and every headline promised wealth. People from all walks of life, bankers, teachers, taxi drivers, were swept into the frenzy. And yet, when 1929 came crashing down, they discovered a painful reality. The market doesn't owe anyone safety, and excitement can be a dangerous guide. Graham saw this pattern clearly. Investors react to noise, panic when prices fall, and chase what they perceive as opportunity, often at the wrong time. They confuse motion with progress and activity with intelligence. Even today, we see the same impulses. Retail investors jump on the latest hot stock, react to viral social media trends, or chase overnight gains in crypto and meme stocks. The tools may have changed, but human nature has not. This is the dilemma every investor must confront. The market is unpredictable, but our reactions are. And that predictability is what Graham spent his life studying. He realized that survival, and eventually success, required self-awareness. You must know your temperament, understand your goals, and choose a path that aligns with both. It is here, in this intersection of personality and market behavior, that Graham defined the three types of investors: the defensive investor, the enterprising investor, and the speculator. Each type faces different challenges, each requires a different strategy, and each interacts with the market in a distinct way.
Understanding which type you are is not a trivial matter. Choose wrongly, and even brilliant strategies fail. Choose wisely, and patience, discipline, and reason become your allies. And so, we begin with the first type, the defensive investor. The defensive investor, according to Graham, is the embodiment of caution and discipline. This is not a timid person, nor someone incapable of understanding markets. Rather, they are deliberate, patient, and protective of their capital above all else. During the tumultuous years surrounding the Great Depression, Graham observed defensive investors quietly holding high-quality stocks and bonds, resisting the siren call of speculation that swept through Wall Street. They didn't chase the next hot tip, and they certainly didn't buy stocks on margin. They understood one simple truth: preservation of capital is the first rule of investing. The defensive investor focuses on safety and stability. Diversification is key. A mix of established, dividend-paying stocks coupled with high-grade bonds creates a portfolio that can withstand market swings. Graham emphasized simplicity here. You don't need to understand every industry or pick every winner. You need to understand the business, its risks, and its price. In modern terms, think of the defensive investor as someone who invests in blue-chip companies or index funds, perhaps with a portion in government bonds. They aren't seeking excitement. They are seeking consistency, security, and long-term growth. They may not double their money overnight, but they also won't lose it in a single panic-driven decision. One of Graham's favorite lessons for the defensive investor was this: don't act out of fear, don't act out of greed, and above all, never let excitement dictate your strategy. Even in today's world of apps that let you trade at a tap, the principle holds. The defensive investor thrives by doing less, but doing it wisely. And yet, for those willing to take on more effort and risk, Graham offered another path: the enterprising investor. The enterprising investor is a different breed entirely. While the defensive investor seeks safety and simplicity, the enterprising investor is willing to dedicate time, energy, and intellect to achieve higher returns. They are proactive, analytical, and disciplined, but never reckless. Graham emphasized that enterprising investors must do their homework. They study financial statements, seek companies whose intrinsic value exceeds their market price, and patiently wait for opportunities where the market has undervalued a stock. They do not chase trends or speculation. Their work is deliberate and research-driven. Historical examples abound. In the aftermath of the 1929 crash, enterprising investors bought stocks at prices many deemed hopeless. Graham himself practiced this method, carefully analyzing companies overlooked by the masses. Those who followed his principles, exercising patience and discipline, often reaped extraordinary returns as the market eventually recognized the true value of these businesses. In today's context, enterprising investors might be those who select individual stocks after deep research, investigate special situations, or buy distressed assets with a margin of safety. They may monitor earnings reports, study industry trends, or calculate intrinsic value themselves. Unlike speculators, their approach is not about luck or speed. It is about knowledge, analysis, and timing grounded in reason. And yet, the enterprising investor also requires patience, the ability to wait for the market to reflect true value. Quick profits rarely come from careful research. Graham reminded us that the market can remain irrational longer than you can remain solvent, so timing, diligence, and temperament are critical. And then there is the third type, the speculator, who thrives on emotion, excitement, and short-term movements, often at great personal risk.
The speculator is a world apart from both the defensive and enterprising investor. Graham was never kind to this type, not because they lacked courage or ambition, but because they often fail to recognize the forces working against them: human emotion, market volatility, and the illusion of certainty. Speculators chase quick profits. They react to headlines, hype, and the movements of the crowd. In Graham's era, they were the day traders of the 1920s, buying stocks on margin with the hope of striking it rich overnight. The result, more often than not, was ruin when the bubble burst in 1929. Speculators live in the short term. They do not wait patiently, do not study value, and often ignore the fundamentals. Their thrill comes from activity, the belief that constant action equals success. Graham warned that speculation masquerades as investing, but the two are fundamentally different. One is disciplined, patient, and grounded in reason. The other is emotional, impulsive, and driven by hope. Modern parallels are everywhere. Retail traders jumping into viral stocks, cryptocurrencies, or meme investments without a margin of safety. The same pattern repeats: excitement, fear, and ultimately loss for those unprepared. Yet Graham didn't dismiss speculation entirely. He acknowledged that some may choose it knowingly, accepting the high risk for potential high reward. The crucial difference is awareness. The true investor understands the rules of the game, while the speculator often believes they are playing a different one altogether. Speculation can be exhilarating, but in Graham's eyes, it is not a strategy for long-term wealth. The key lesson remains: success in investing comes not from motion or excitement, but from self-knowledge, discipline, and patience. Now that we understand the three types, the next question is, how do you identify which type of investor you truly are? Knowing the three types of investors is one thing, but discovering which one you truly are is another. Graham believed that self-awareness is the foundation of all successful investing. Without it, even the most brilliant strategy can fail. Start by examining your temperament. Do you find comfort in stability, or do you thrive on research and analysis? Are you prone to impulsive decisions, or do you prefer to wait patiently for the right opportunity? Your answers reveal your natural investor type. Consider time and commitment. The defensive investor does not want to spend hours analyzing companies every week. They prioritize peace of mind and stability over maximum returns. The enterprising investor, on the other hand, is willing to dedicate effort to uncover undervalued opportunities, understanding that the work itself is part of the strategy. The speculator, often drawn to action and excitement, may enjoy trading frequently, but risks succumbing to emotion-driven decisions. Graham warned that misalignment between temperament and strategy is dangerous. A defensive investor trying to pick individual stocks like an enterprising investor risks anxiety and losses. An enterprising investor trying to follow a passive, defensive approach may become frustrated and impatient, abandoning their strategy at the worst possible moment. Historical anecdotes illustrate this well. In the 1930s, those who tried to speculate in falling markets often lost everything, while those who adhered to their temperament, whether defensive or enterprising, survived and even thrived. Today, the lessons are identical. Follow your natural style, not the lure of short-term gains or social pressure. Ultimately, the question isn't which type is best, but which type fits you, your personality,
your goals, and your capacity for patience. Once you know that, you can structure your approach to investing in a way that is sustainable and aligned with your own strengths. And no matter which type you are, there is one principle that applies universally: patience.
Patience, Graham taught, is the silent engine behind every successful investment. Whether you are defensive, enterprising, or even speculating knowingly, your ability to wait calmly and rationally determines whether you endure or falter. In Graham's era, markets were volatile beyond imagination. The 1929 crash obliterated fortunes overnight, and the following decade saw investors navigating uncertainty during the Great Depression. Those who reacted impulsively lost everything. Those who exercised patience, adhering to their chosen strategy, survived and ultimately prospered. Patience does not mean inaction. For the enterprising investor, it is the discipline to wait for the right undervalued opportunities, to study financial statements, and to act only when conditions are favorable. For the defensive investor, it is the quiet confidence to hold quality assets, ignoring the noise of short-term swings. Even for the speculator, those who succeed understand the importance of timing, controlling risk, and resisting the temptation to chase every movement. Consider modern parallels. The investor who buys a diversified portfolio and holds it through market cycles often outperforms the one who trades constantly. The patient investor doesn't succumb to fear during downturns or to greed during bubbles. They recognize that markets may be irrational in the short term, but value endures over time. Graham's genius was in understanding that patience is not passive. It is an active choice. It is choosing to act deliberately rather than impulsively, to rely on reason instead of emotion, and to trust that the careful application of timeless principles will prevail against the chaos of the market. And yet, even with patience, mistakes can happen. Each type of investor must also understand the pitfalls that come with their temperament. Every type of investor has its own pitfalls, and Graham was keenly aware of them. The defensive investor, for all their caution, can become too conservative. They may avoid undervalued opportunities out of fear, missing the very gains that could have improved their long-term results. Graham warns that excessive caution can be as damaging as recklessness. The key is balance. Protect your capital, but don't let fear prevent growth. The enterprising investor faces a different challenge. Their analytical drive can turn into overconfidence. They may believe they can outsmart the market at every turn, taking on unnecessary risk or misjudging value. Graham emphasized that diligence must be tempered with humility. Even the most careful research can be wrong. The margin of safety is their shield against human error. The speculator, by far the most vulnerable, struggles with emotion and impulsivity. Thrilled by excitement and chasing the next opportunity, speculators often ignore fundamentals, trade excessively, and let greed and fear dictate their decisions. Graham observed that few speculators survive long-term. The market inevitably punishes haste and hubris. Historical examples make this clear. In the 1920s, defensive investors survived by sticking to bonds and stable stocks. Enterprising investors prospered by buying undervalued companies after the crash, and speculators who chased fads lost everything. Today, the cycle repeats. Reactive traders chase viral stocks. Defensive investors sit safely in diversified funds, and disciplined enterprising investors profit from overlooked opportunities. The lesson is simple yet profound. Knowing your type is not enough. You must understand its weaknesses, guard against its temptations, and follow your chosen path with discipline. And finally, once you understand your type and its pitfalls, Graham's advice points to the ultimate step: choosing your path wisely. Graham often said that the best investment strategy is the one you can follow consistently. Choosing your path wisely isn't about copying others or chasing what seems profitable today. It's about aligning your strategy with your temperament, goals, and capacity for patience. If you are naturally cautious, The defensive approach allows you to sleep at night while steadily building wealth. If you enjoy research and can dedicate time and energy to analyzing businesses, the enterprising route can generate superior returns. And if you are drawn to excitement and understand the risks, speculation may be a conscious choice, but one that requires vigilance and discipline. Graham warned against pretending to be something you are not. A defensive investor trying to emulate an enterprising one risks frustration and loss. An enterprising investor attempting a passive strategy may abandon it at the worst possible moment. Success comes from understanding who you are, accepting it, and following a methodical approach tailored to your strengths. He also emphasized the role of patience and restraint. The path you choose will test your discipline, and the market will constantly tempt you to deviate. Stick to your principles. Trust the process. Allow time to compound your efforts, and avoid being swayed by the noise of the crowd. Historical examples illustrate this clearly. Those who survived the Great Depression did so not by reacting to every market swing, but by committing to a strategy suited to their temperament. Today, in an era of instant news and trading apps, the lesson is the same. Clarity about your approach, combined with patience and discipline, is far more valuable than chasing fleeting excitement. And so, having chosen your path, we come to the final lesson Graham left for every investor, a truth that transcends eras, markets, and technologies. Benjamin Graham's wisdom reaches beyond balance sheets and stock prices. It speaks to human nature, behavior, and the disciplined pursuit of long-term success. Understanding the three types of investors, defensive, enterprising, and speculator, is not just about categorizing strategies, it is about understanding yourself. The defensive investor learns the value of patience and simplicity, preserving capital while steadily building wealth. The enterprising investor channels curiosity and effort into disciplined research, seizing opportunities others overlook. The speculator, if they choose to engage knowingly, must respect risk and guard against emotion-driven decisions. Across all types, Graham's principles endure. Know your temperament and act accordingly. Protect your capital first, pursue opportunity second. Study value, not hype. Exercise patience, restraint, and discipline in every decision. History and modern markets alike confirm these lessons. The headlines, the chaos, the trends, they may change, but the human impulses Graham identified remain. Greed, fear, impatience, these are constants. And those who understand their type, recognize their weaknesses, and follow reason over emotion are the ones who thrive. As you navigate investing today, remember that the market is less a puzzle to be solved and more a mirror of human behavior. Your greatest asset is not your intelligence, your access to information, or your timing. It is your ability to act wisely in accordance with your own temperament and to let time work in your favor. Graham's voice echoes across decades, whispering this timeless truth. Success in investing is less about action and more about understanding of yourself, of the market, and of the enduring principles that guide wealth through time. The market may roar, trends may dazzle, and speculation may tempt, but those who know their type, who act with discipline and patience, and who respect the lessons of history will endure and prosper where others falter. Because in the Graham way, investing is not a game of chance. It is a practice of wisdom, patience, and self-knowledge. And it is a practice that, when followed faithfully, transcends time, technology, and the fleeting excitement of every passing market moment.